So this is my stock portfolio, and we'll be filling in this pie chart with the top 9 stocks to buy now, each focusing on one of the most important technologies driving value in the market today. Because when it comes to picking great stocks, it's important to understand a company's products and not just their numbers. If you had put $10,000 into Nvidia 5 years ago, that would be worth $150,000 today. And that kind of massive growth happens when a company has the perfect product in a quickly growing market before that market appears, like Nvidia. So let's get into it and start by putting my money where my mouth is by showing my personal stock portfolio. So you can see my portfolio is up a little bit over 40% over the past year, but it's been not a straight line at all. We had this huge sell-off between February and April, and really the back half of the year has just been recovering some of those lost gains. This is because I invest in a lot of technology and growth stocks, since that's what I know the most about, and they can be very volatile. As we'll see when we start going through the specific stocks that I hold, the biggest risk right now would be some form of sector rotation, where money moves out of technology and into another area of the market, like energy. So we'll be covering both the market trends as well as why I think these specific stocks will outperform, based both on their financials and their products, using my experience as a solution architect for over a dozen Fortune 500 companies. So starting out with our first stock, we'll get into some of the fun stuff like AI and quantum. I know, I read the comments, and we'll talk about what there is to love about these companies as well as the risks to watch out for. But let's start in an industry that is expected to reach $1.5 trillion by the end of the decade: fintech. So my first stock just reported blowout earnings, is growing faster than most companies, a tenth its size, and just announced a new product that could change the way that people bank. But there are 2 big risks that investors will need to watch out for. So the biggest news with SoFi this month is their latest reported earnings that absolutely blew expectations out of the water. Their adjusted revenue grew 74% year over year, which means it is accelerating from the growth that it had the last couple years. And we'll see in a second how that ties in with their product strategy going forward that I think the market is underestimating. But even more important than this company's revenue growing is their overall adjusted EBITDA growing. This is effectively their profit if you take out interest, which for SoFi means you take out the banking side of their business and focus mainly on their products. That has grown to 29% margin year over year. And if we look at this in Forecaster, we can just see how if we zoom out, SoFi's growth has been absolutely incredible over the last couple years. But what's crazy is as they're becoming bigger, they seem to be growing even faster. But of course, growth comes with risk because eventually the market prices in that growth. And so if you don't keep up that pace of innovation, the stock price can drop rapidly as well. So let's look at my long-term prediction for the stock, as well as 2 risks that they'll have to overcome in the short term. So the most important thing to understand about SoFi is how their products work together. They call this their financial services productivity loop, where they get a new customer into the ecosystem with something like SoFi Money, their checking and savings account, or maybe a SoFi Invest account. Then they slowly upsell them onto more and more products, like SoFi Relay, their personal finance product, or maybe they get them signed up with SoFi at Work. Eventually, they move them into the more valuable areas of the company, like personal loans, student loans, and home loans, where they've traditionally made most of their profit. But what makes this a loop is once a customer signs up for their home loan from one of these other financial services products, they're actually something like 2 times more valuable than someone who comes in directly for a SoFi loan, which is not something you see in every company. And we know the company is still very focused on innovation and investing in new products. They've recently started focusing on allowing Main Street investors to invest in private companies, following a model that Robinhood has been pushing recently, which SoFi CEO Anthony Noto explained in an interview with CNBC.
You're expanding to private markets investing. How big of an opportunity is this for SoFi?
We think it's a large opportunity. It's part of our overall strategy to be a one-stop shop for all your financial services needs, and we're giving access to Main Street investors to products they would not otherwise get in prior history. We're the exclusive retail provider of the Rivian IPO, as an example. And then about a year ago, we launched alternative assets, including private equity, and then even an opportunity to invest in some private companies, specifically through SPVs like Anthropic as well as SpaceX.
So all SoFi really has to do is keep up with the market in each of their individual products. They don't have to be a leader as long as they're a fast follow second. And because their monetization model is more efficient, they can make more money on it than a company like Robinhood could. But look, I've owned this stock for a while. I've talked about it on YouTube for a while. And I think it's important to talk about the risks before investing in any company. So there's two really big ones that I'm focusing on for SoFi right now. So the first one is kind of based on this slide from SoFi's latest earnings report. This talks about how SoFi's lending platform capabilities have changed over time. Traditionally, SoFi was just a normal loan company. They made money selling a loan, and then they made money holding a loan and making interest when people made payments. But today, the company has been aggressively pushing into their loan platform business, where they originate loans for other companies to actually run using SoFi's predefined criteria. So they're basically paid a fee for making the loan, but they don't hold the risk on the loan. And one of the reasons SoFi's CEO, Anthony Noto, has been so focused on this is because when you hold loans, you are at the whim of what happens in the economy. If interest rates go up, you make more money, and if they drop, you lose a lot of money. And SoFi wants to be diversified, not beholden to whatever happens in the market. This is why banks rise a ton during boom times and then drop quickly during bad times. And so that's the first big risk with SoFi, interest rates. If we see a big interest rate drop, which tends to happen during a recession, SoFi's stock price will probably drop right along with it. They still make a decent amount of money from the loans they already hold. And if we look at this chart, which is a chart of the total delinquency rate of debt in the US over the past 25 years, 40 years actually here. So we can see there was a big spike in 2008, and since then we had a pretty consistent drop in delinquencies. Makes sense. But if we zoom in more on the last couple years, ever since the lowest amount of delinquencies just after the pandemic, we've been seeing a steady rise in those delinquencies since then. Not at dangerous levels, but worth watching. But we're also seeing higher levels of debt than we've ever seen before. And a decent amount of this is coming from student loans, credit cards, and auto loans, which can be even more risky than housing debt like we saw in 2008. So lowering interest rates could be a risk to SoFi, and they're trying to address it by diversifying their loan products, and rising delinquencies could be a threat to SoFi, which they try to address by only taking on the best borrowers they can find. Their average personal loan borrower makes $160,000 a year, and their average student loan borrower also makes over 6 figures. So worth watching out for, but I obviously still hold the stock. I hold over 3,000 shares in the company, valued at over $66,000, and that's made over $45,000, up over 200% while I've held it. But next, let's get to an even faster growing fintech, and then we'll get to one of the best discounted stocks that I see in the market today. So this next company has become one of the largest fintechs in Brazil, recently brought back its founder as leader, and is now absolutely taking over the fintech market in Mexico as well. And I guess because this isn't an American stock, the price of this thing is like half of what I've seen for similar US companies. So Nubank is a Brazilian super app, which is less common in the US, but is very common, especially in emerging markets. They bundle everything from NuPay, allowing people to pay with their phone, to things like a shopping service built directly in, something like an Uber delivery, to an investment service similar to a SoFi or a Robinhood, and they even have support to run business accounts directly on the app, with all the security features necessary for the specific markets that they operate in. So this company started as a small startup in Brazil, but they have rapidly grown to become the biggest fintech in the market, with over 118 million customers, and they have expanded to both Mexico and Colombia. And we can see how their growth has continued in these new markets. So it's kind of like the company has already won in Brazil, and now they're gearing up for their second life, trying to conquer other markets as well with their hyper-localized products that are adapted to the local culture. And part of the big news for this was the company brought back their original founder to help lead this new level of growth. The company has this interesting slide here, which basically says they own less than 1% of what is possible in the Mexico market. The biggest piece they have is in credit cards, where they only own 2%, but Mexico is still a very early market for these new technology capabilities. And if they're able to have even half the success in Mexico and Colombia as they did in Brazil, that could be a huge boost to their stock price, with the company only recently clearing a major hurdle in securing a Mexico banking license. But a stock like this is only worth buying if you can get it at a decent price. So let's take a look at it inside Forecaster. We can see from their fundamentals the company's ridiculous growth rate here, but that has also resulted in a relatively high price. So Forecaster actually combines 4 different valuation metrics. The first one is discounted cash flow, which is basically the total cash the company throws off, which they say would value the stock at around $8 per share. their PE ratio should be around $7 a share, which is just a measure of the total value of the company divided by how much profit they return to shareholders. While two other valuation metrics, including economic value added, which is basically how much profit you generate from your capital, these numbers can get a little wonky for a tech company, so maybe not the best valuation metric, but this says the company is only worth a price of 2. And then EV to sales, which is the enterprise value of the company compared to how much revenue the company makes. This would actually value the stock closer to $17. So I like to show all 4 of these because there's different ways to value a company, and when Forecaster puts those together into an average fair value, they come out to a stock price of 9 as the ideal for right now, which puts the company at 27% above their calculated fair value. Now, I think that economic value added is not a great metric here since they are mostly an app, and none of these metrics properly account for the company's growth. Considering the company added 40% to their revenue year over year, if they even continue to grow at half that rate in the future, very quickly these numbers will start to rise, and I'm pretty sure this average fair value will look way too low 2 or 3 years from now. It's not worth buying any stock at any price, but it is sometimes worth buying stocks based on their future growth rather than based only on their current numbers, which is why I currently own 13, almost 1,400 shares in this company, valued at $17,000, and it is up 27% during the time that I've held it. It's a cool little stock. Shout out to Future Investing, who told me about this stock a few years ago. But now let's move from the fintech space to a value stock, a company that is the cheapest I've ever seen it, and I think you'll be surprised at the reasons why it's so cheap. I mean, I love it when the market will give me a 20% discount coupon just because hedge funds are scared of something. So we'll look at why PayPal has a relatively low price compared to how much profit they make, the company's big bet on making the digital wallet of the future, meaning cross-border, fast, low-fee transactions worldwide, and how that's going to impact what they see in the future of payments. So lots to cover on this one, but it's really worth knowing because this stock could really be a diamond in the rough right now. So PayPal's stock price is down over 20% year to date, and the company's PE ratio puts them at 14.6, which is now below the average in the stock market. Now, normally a tech company would be valued at 2 or 3 times what the average stock market company is. PayPal is valued lower than the average, so there's clearly something going on. One of the issues facing PayPal right now is they're currently undergoing a $300 million restructuring, which involves cutting a lot of jobs, but also overhauling their existing technology infrastructure, which was built on technology built 20 years ago. And if we quickly hop into Forecaster before we get back to the news on this, we can see how this has impacted the company. So in blue, the bigger bars, we can see that their sales, their revenue has continued to grow, while their profitability, the little green bars at the bottom, took a big hit in 2022, and they still haven't recovered to the same levels that they saw back in 2020. But I see most of these difficulties as fairly short term. So as part of PayPal's turnaround, they have 4 big strategic growth drivers that are driving them. These are like the parts of the business that they expect will help them turn around and become more profitable in the future. The first is what they call Win Checkout. Basically, they want to become the default checkout option in as many apps as possible. And they've seen 45% growth in their Pay with Venmo, as well as 20% Buy Now, Pay Later growth. And they're trying to drive this growth by doing things like offering 20% cash back when you check out with these services. They want them to become the default so that later they don't have to offer these same incentives and people will just keep on using them. I think the strategy could work. It'll be hard to compete with Apple Pay, but I think on non-Apple products, they'll probably be okay here. But the next big area of growth is scaling Omni and Venmo. One big area they're focusing here is by launching Venmo debit cards at college campuses, because while Venmo's not very popular outside the US, it is very popular in colleges where people use it to send small amounts of money back and forth to cover things like a restaurant or a bar tab. So these two drivers together, they call their branded experiences. So it's a very marketing-led push. The other area they're focusing on is becoming more profitable as a payment service provider. This is like a business charging money to another business. And then lastly is scaling next-gen growth vectors. What is going to be the future of PayPal? And they lay out a couple things here, potentially agentic experiences. So if an AI could do your shopping for you, how do we get them to pay with PayPal rather than another service? Or how can we create personalized ads that let you check out directly on another website's page? Or how could they work with cryptos and stablecoins to become part of that ecosystem? The big change that PayPal is trying to addressing with all of this is how people are going to use digital wallets going forward. A digital wallet could be checking out on your phone, but it could also be the wallet the AI has access to buy things for you with restrictions around it. And it could be connected to a stablecoin if you want to do foreign transactions without the same international foreign transaction fees. And a couple weeks ago, PayPal's CEO actually talked about this with CNBC.
Digital wallets are how people want to pay. Digital wallets hold multiple credit cards. They may hold digital currencies. They may hold buy now, pay later options. There's lots of different options around the world. But the challenge is these wallets don't interoperate. And so if you're traveling, if you happen to be wanting to exchange money on a peer-to-peer basis with another consumer that has a different wallet, you run into a challenge.
And so PayPal's idea to integrate all these different wallets is a new service that they're calling PayPal World, which supposedly is coming later this year. And the ideal is to connect all the different digital wallets around the world to make payment easier. I'll tell you, as someone who works with people from all around the world as part of this YouTube channel, sending money internationally is still not really a solved problem. It can take a really long time or just be very expensive to do. So at least from a business perspective, I can absolutely see the value here. And if PayPal is able to pull this off and successfully unite the digital wallets of the world and digital wallets become a bigger and bigger part of our lives, this could be a serious growth driver for PayPal going forward. So the biggest risk with PayPal is just that they do not turn around successfully and they kind of continue on the path that they've been going down. No real growth, potentially dropping profits in the future as more and more competition comes into the payment space. And there was one interesting chart that I wanted to share. This is a chart of PayPal's total shares outstanding pulled from Fiscal AI, and we can see that PayPal has been continuing to buy back shares, which puts upward pressure on the stock price. This is actually the opposite of what SoFi is doing by currently diluting their shares, and it's a sign of a company that has clearly made missteps in the past, but they have enough cash that they're willing to invest it in improving the share price for their shareholders. That's kind of a short-term benefit, but if you're looking at PayPal today, that could benefit you. And if we just quickly look at this company's valuation and forecaster, we can see that it predicts it is 73% below the fair value today based on these four valuation metrics. So it's a rare case of a technology stock that is also a pretty good value at current prices. Okay, now we move on to some of the fun stocks that a lot of people in the comments have been requesting. So look, AI as a market has tons of BS, tons of marketing hype, tons of products that don't really do anything. And so I'm going to be putting on both my solution architect cap to make sure these are real valuable AI products and my investing cap to try to find decent value in the AI space. And I think I found two stocks that meet those criteria. So the first one is a company that has, in my opinion, the greatest track record with historical tech changes, has extremely competitive products in the AI space, and has the cheapest price for any of the big AI players today. So the next stock is Alphabet, which I'll just call Google because let's be honest, who calls it Alphabet? Next thing we know, they'll try to call it Alphabet Intelligence instead of AI. Okay, so why do I like Google as someone who works with AI for a living? At least when I'm not talking to a camera in my living room that is currently extremely hot, so if I start sweating, I'm sorry. Well, some people don't realize, but Google is one of the oldest companies to actually operate in the AI space, which doesn't mean a ton because it's not that old, but they have been iterating on the initial AI ideas for a very long time, inventing the ability for computers to learn on their own so that they can get smarter over time, which is really what AI is. In fact, the latest AI models that companies like ChatGPT or OpenAI are currently using are actually built on the foundational research that Google originally published. And even to this day, Google operates some of the biggest open source libraries for AI, and their Google DeepMind division is right on the cutting edge with the latest AI models, up there with OpenAI and arguably a little bit ahead of other companies like Anthropic. So the reason a lot of people aren't as familiar with Google's AI is because for a long time, they were really focused on the B2B space. This right here is actually Google's cloud console. This is their Vertex AI, where big companies will go to actually create AI products that they then sell to their users. And Google has had some extremely advanced technologies built into this for quite a while. I mean, look, I could create an ad just based on providing a video. Let's see how this works. Okay, we got some people surfing, and what did it do? Feel the call of the ocean, experience the thrill of the ride. Okay, it's a little bit sappy, but I mean, this is legit copy you could use for an ad. But a lot of people didn't realize that Google had these capabilities because the only people using it were nerds like me. Now, recently they've expanded more to basically copying the ChatGPT application. You can now actually talk to Gemini directly in an internet browser, just like with ChatGPT. But maybe more importantly, you can talk to it directly on your phone. This is a Google Pixel device, so it's actually built in directly here, and I can actually chat with AI over all of my Google storage if I really wanted to. This gives them an advantage over a company like OpenAI because Google just has so much more data available to them. But that's all solely my solution architect hat. Let me look at it from an investor perspective for a second. So how could Google's products actually make them enough money for the stock price to rise? Well, Google has been investing very heavily in capital expenditures, basically buying up more and more data center capacity to train new and more powerful AI models and to run their existing AI. And at least for now, that is a true investment. They are not making money back on that, at least not enough to cover all of it. Most of their return on that is coming from Google Cloud, which has grown their revenues 32% year over year. This is accelerating growth despite this company already making $13 billion off of this per quarter. Basically, if you're a company that wants to build with AI, Google Cloud is probably the best place to start with that. And then once you're using their AI services, you might sign up for other services as well, like hosting your website, storing your data, or even building other applications. And then of course, the other big area that AI helps them is in their Google services. This includes things like Google Search, YouTube Ads, the Google Network, and all of their subscriptions, platforms, and devices combined. Now, at least in this market, I actually think this is more Google's space to lose because they already have the biggest search engine and AI could cut into that space. So I'm not as concerned with Google growing their Google search business using AI or making more money there. I just want them to try to keep as much of that as possible while growing as much as possible in Google Cloud. That to me is the really big play. But let's see how likely that is based on Google's current stock price. So I think the best way to look at this is how they compare to their competitors. Google currently has a PE ratio of 187. Microsoft has a PE ratio of 480, and Forecaster actually says that's about where the fair value should be. While Meta has a price to earnings ratio of 537. So Google is half of Microsoft and about a third of what Meta is valued at. And I think the reason for this is because the AI is not showing up in Google's numbers yet. It's still just an investment and it will probably come in the future. Versus Meta has been leaning very aggressively into AI on Instagram, and then Microsoft had a big partnership with ChatGPT maker OpenAI that gave them an early lead in the space. But I think Google is catching up and I'm willing to put money on it. I currently own 123 shares of Google valued at $24,000, and that is up 18% over the time that I've held it. But now let's move on to the most controversial stock that I've talked about on this channel.
I'm serious. Every time I cover this stock, it's like half the comments think it is the worst stock ever, and the other half are like, wait, that's an AI company?
But I kind of like that it's controversial because controversy is where the deals are. If everyone agrees it's a great stock, the price is probably already as high as it's going to be. If some people hate the stock, there could be an opportunity to buy in early. So this company has one of the best AI teams in the world, is partnering with Google to become one of the top self-driving car services, and billionaire investor Bill Ackman recently put $2.3 billion into the company. And this is the type of stock that could easily double in value in a few years, but there is a big elephant in the room, risk with this company, which you'll probably spot pretty quick when I start talking about their products. So Uber is the next stock, and this kind of blew my mind, but did you know their stock price is up over 40% in the past year and up 181% in the past 5 years? This is one of those companies that's always kind of flown under the radar for me, and I think because of that, there could be some decent opportunities for investors to get in at a decent price. So first off, why am I lumping Uber as an AI company? Well, Uber actually has a fairly old and mature AI team. I think of them as a rideshare service, but this is a totally separate business where they actually do data labeling, testing, and localization for businesses, which is the very manual, time-intensive task of turning data into something that is useful for AI. And we've seen companies like ZCAL AI, which does this exact same thing, get a $14 billion investment from Meta in order to strengthen strengthen their model training. So it's a very valuable service that they're working on, and some of their partners in self-driving are benefiting from this as well. That's the other big thing. I didn't realize how big Uber was in self-driving at first, but they've been actively partnering with some of the biggest self-driving companies in the world, including Waymo. They're also partnered with Aurora and Niantic, not to mention all these other AI companies. But one criticism that I hear about Uber is that they're a dying company, that no one likes their service and no one's using them anymore. And I saw some comments on the last video where I talked about Uber kind of along those lines. So I wanted to look at the data to see how much that's actually reflected in their latest earnings. So the company just announced their most recent earnings, and they actually beat on revenue and announced a $20 billion stock buyback, which indicates that they think their own stock is undervalued. And far from being a dying company, it looks like their trips and gross bookings actually grew 18% year over year, and their adjusted EBITDA, basically their profit, is up 75% year over year, with the company making a ton of cash. So at least in the short term, it looks like there's some pretty clear value in the stock, but I think the bigger thing with Uber is people look at its long-term potential, and that's where they see the biggest risk. So the big capital RISK risk for this company is self-driving cars from companies like Tesla. Because if people's cars can just drive them around for them, or they can even rent out those cars to other people, you don't need a service like Uber to bring all the Uber drivers together. And I think this risk is what has prevented Uber's stock price from rising as much as it really could have. But I think the opportunity here is that risks are not binary. It's not this will happen or this won't happen. And so the question is, how much should we discount Uber's stock price based on the risk of self-driving ruining their business? Should the stock be 10% cheaper, 20% cheaper, maybe 50% cheaper? It's hard to say exactly, but billionaire Bill Ackman has made a very public position on this. He announced that back in January, they had began acquiring a position in Uber, and as of their latest 13F filing report, they held what is now worth over $2.3 billion in the company. And Bill Ackman, if you don't know him, is the billionaire owner of Pershing Capital, which has far outperformed the S&P 500 over the lifetime of the fund. And he's made some really big bets on basically brand turnarounds, including companies like Wendy's as well as Chipotle. If we look at the company's fundamentals, they're basically valued where they should be, 9% above the fair value, but that jumps up and down. And with the company buying back shares, that should continue to boost the stock price in the short term. But really the big bet on this stock is exactly what Bill Ackman laid out in his company's earnings report, which is that autonomous driving companies are more likely to partner with Uber than try to compete against them, that their product diversification kind of insulates them from a lot of the risks, their AI services, for example, not really impacted by autonomous vehicles, and that autonomous vehicle introduction probably isn't going to happen for at least the next couple years, and when it does happen, it would expand the rideshare market rather than directly competing with existing entrants. When you automate a market, it usually gets bigger. It's still a risk, it just might be a little bit overly priced in at the moment, and that's a bet I'm willing to take with 100 shares of Uber, currently worth $9,000, and I just bought it recently, so it hasn't really moved in price. And I'm only blurring the other stocks on screen, so it's a little bit easier to see. I will share my full stock portfolio at the end of the video, plus I always share it on my Instagram at RealFinTech. But let's now move on from AI, the big investing trend today, to what I see as the biggest investing trend of the next decade, cybersecurity. And then after that, we'll look at two quantum stocks. Now, cyber and quantum are actually fairly closely connected, but let's start with a stock that was just named a leader by Gartner in endpoint protection for like the 6th year in a row, and as the most innovative company in cloud and application runtime security. And more importantly, a company whose numbers keep improving each quarter, with their opportunity in cybersecurity only growing larger. But we'll also look at why their success has made them a target, and some of the serious missteps that they've made on the way to growth that could hold them back in the long term. So the next stock is CrowdStrike, a company you may know because they caused the biggest blue screen of death outage in known history last July, or because their CEO is also a race car driver. But if you work in the cybersecurity space, you probably know them because of their products. CrowdStrike is one of the first companies to really integrate AI directly into cybersecurity. And while nowadays that means large language models and agentic workflows, basically everything ChatGPT does. In the past, they've been using AI for years for things like spotting threats before they actually impact a customer. And we know their products are great because they've been a leader according to Gartner for 6 straight years. They're also a leader according to Forrester, and they are a leader according to IDC, which, if you're not in the tech space, just means they have the best current products and the best roadmap toward future products. Now, this company is actually expected to report earnings just a few weeks after I'm recording this video, but the big play with this company is growth. If we just take a look at their sales over time, they have been growing at effectively an exponential rate over the past 7 years, reaching just short of $4 billion in 2025. But at the same time, the company still boasts a fairly high stock price, 50% above their fair value. So the question is, will the stock grow fast enough to make up for this high value? And I think there's a couple reasons to believe that it will. Number one is the cybersecurity market's growth in general. The market size is expected to reach $875 billion per year by 2034, a growth rate of 12.6% compounded. A separate estimate breaks that out by cybersecurity services versus solutions, basically technology platforms versus the people actually running the cybersecurity. CrowdStrike does a bit of both, but both agree that the market will grow at a little over 12% per year, which is around 3 times faster than US GDP. And this is the reason that CrowdStrike sees their total addressable market in AI native cybersecurity hitting $250 billion by 2029. There are a lot of people who love to use AI marketing talk, but CrowdStrike seems to actually be walking the walk as well as talking the talk. And this is why their customers continue to use the platform. 48% of them use 6 or more modules, 32% use 7 or more, and 22% use 8 modules. So when a customer signs up for one part of CrowdStrike's platform, they tend to use more parts of the platform in the future because they like how it works. The company's stock price has been very volatile recently. It actually plunged 13% the day that I'm filming this. And of course, the massive outage they caused when they accidentally pushed an update to Microsoft wiped billions off the company's value overnight. But whenever I see volatility like this, I see it as the market not totally understanding where they should put the stock. Should they value it up here or down here? And it just keeps bouncing between those two. Warren Buffett has a really nice analogy for this. In a 1987 letter to Berkshire Hathaway shareholders, he talked about the idea of Mr. Market, which is an allegory where you think of the stock market as one guy, a business partner, who basically offers to buy your shares off you in a company on any given day. So if I own CrowdStrike, I am a business owner of CrowdStrike, and this guy comes and offers to buy a piece of the business. Sometimes Mr. Market's idea of value appears plausible and justified by business developments and prospects as you know them. Often, on the other hand, Mr. Market lets his enthusiasm or fears run away with him, and the value he proposes seems a little short of silly. So if you're a prudent investor or a sensible businessman, would you let Mr. Market's daily communication determine your view of the $1,000 investment in the enterprise? You may be happy to sell out if he quotes a ridiculously high price, and equally happy to buy from him when his price is low. But the rest of the time, you would be wiser to form your own ideas of the value of your holdings based on the reports from the company about its operations and financial position. So don't get me wrong, it can be stressful holding a company that bounces up and down a lot in price, but when I think about it, the actual value of the company hasn't really changed. And so that's why I've continued to own the stock, and I think that long term, they will be the winner in cybersecurity, and the cybersecurity market itself will also just continue to expand far beyond where it is today, which is why I currently own 116 shares in the company, currently valued at $49,000, and that is up 180-ish% over the time that I've owned it. But before we get to the next stock, I should just say this is a good example of why you shouldn't just copy my portfolio, because I tend to hold stocks for over 5 years. I've held CrowdStrike for more than 5. But if you just bought the stock in 2021 and then you sold in 2022, you would have lost 66% of your value. So if you're a short-term holder, you might have lost money. Versus if you bought at the peak in 2021 and held long-term, you'd be up 68%. So for all of these stocks, it's worth considering if your personal investing goals match up with the goals that I have, which is long-term wealth building and eventually using the money in retirement, not trying to flip the stock and make a short-term return in a year or two. Okay, but next we're going to look at a stock that looks a lot like CrowdStrike did 2 years ago, that is also battling a growing wave of AI cyber attacks and has a lot of room to grow in front of it. So Zscaler is a cybersecurity company that specializes in zero trust security, which is basically the best way to handle security in a cloud workload, which is becoming more and more common. But with all that data in one place, we're also seeing a rise in things like ransomware ransomware, which has surged 146% year over year, and Zscaler's threat labs actually uncovered a surge in AI-driven cyber attacks that are targeting critical business operations. So in a world where people are now using AI to actually precisely attack companies, security becomes more important than ever, and that's where Zscaler comes in. Zscaler currently sees the total addressable market that they're going after as $96 billion per year. The company, like CrowdStrike, has been growing absolutely incredibly quickly, and what I like about this company is while they are not yet profitable, their net income is approaching zero, which means that as the company is scaling, they are becoming more efficient, and eventually they'll reach profitability, which could make them eligible to join something like the S&P 500. This is a company that is growing faster than the cybersecurity market, and they're in a cybersecurity market that is already growing very quickly, as we saw with CrowdStrike. So it's kind of like a company with two engines behind it, pushing them to greater and greater heights. The biggest risk with this company would be valuation. Forecaster puts them as 34% above their fair value, but I expect the company will continue to grow into it, and once they hit profitability, I could see there being a boost in the stock price once certain hedge funds are now allowed to invest in the company that are not allowed to invest in non-profitable stocks. So for Zscaler, I hold 82 shares in the company worth $22,000, and that is up 15% overall. And I had some comments on the last video asking what this platform is. It's called Forecaster, and it's got some pretty cool functionality built in. They keep on adding new features. They have this political measurement now, so you can actually see which politicians are buying in and out of the stock, which is nice because Congress are some of the best investors on the planet, actually. I made a whole video on that. And they also have the Forecaster AI agent that can do things like explain what the business actually does, as well as look at who the competitors are, or even who the biggest suppliers and clients of the company are. It's like a little dashboard to figure out everything you need to know about a stock, and I've been using it more and more. So I'll have an affiliate link below this video, and I'll pin a comment where you'll get 10% off if you use that link. But yeah, if you're looking to go deeper on any of these stocks, this platform's a good place to start. Okay, but let's go now to the very forward, future-looking tech, quantum computing. This is still a very early technology, but no one argues that it is eventually going to be massive. It's just a question of when. So for quantum, I want to look at two stocks that are both decent buys today, as well as have the potential to grow as the quantum computing market starts to mature. And after these, I'll also share every other stock in my portfolio that I didn't have time to cover in this video. So the first quantum stock is an ETF, basically a basket of stocks that tries to track the broader quantum market. So let's look at the biggest stocks in this ETF, why they'll benefit as quantum grows and when, as well as look at some caveats and risks with buying into this new market. So the only ETF that seems to currently exist to invest in quantum is the Defiance Quantum ETF. The ticker symbol is QTUM, and the ETF has actually done quite well over the past 5 years, up 176%. And the growth in the quantum market is expected to continue. It's only at $1.6 billion in actual productive revenue right now. The rest is pretty much research, but it's expected to reach $7.3 billion by the end of 2030, a compound annual growth rate of 34% per year. So it's a slow start, but once it gets going, it's going to look like an exponential. So the top holdings in this ETF are a mix of pure quantum plays, companies like Coherent or Rigetti, as well as the companies that will likely be benefiting from the quantum market, companies like AMD or Palantir or Oracle. We even have stocks like Nvidia on here. This is because as quantum develops, it's likely going to be used to train new AI models that will benefit stocks that are in the AI space. And this is why we've seen a lot of investment in quantum early on, both from researchers as well as places like the US Department of Energy, because theoretically, a powerful enough quantum computer could hack any computer in the world in an instant, if they're not using quantum-resistant cybersecurity. We've also seen big investments from the banking industry, including JP Morgan, Citigroup, as well as healthcare, which we'll see with the next stock has been a big area of focus in the quantum space. So everyone agrees that quantum will matter a lot in the future, but there's some disagreement over when. Nvidia's CEO, Jensen Huang, has said quantum is nearing an inflection point, and that we are within reach of being able to apply quantum computers in areas that can solve some interesting problems in the coming years. But there's a caveat there, saying that they're probably not going to be commercially viable in the near term, and it may take more like 20 years for that to be realistic. Now, the thing is, from Jensen's perspective, what matters to him is when quantum would be relevant to a company that's NVIDIA's scale. And yeah, 20 years to hit that kind of scale could be. But the quantum market is growing at a ridiculous pace right now. I mean, if we just look at a compound interest calculator, let's see, over 20 years, if it continued to grow at 30% per year, the quantum market would be 350 times bigger than it is today. And over a much shorter time period, like let's say 10 years, it will be 18 times bigger than it is today. So really, if you're buying into the quantum ETF right now, a lot of what you're buying are just solid AI and semiconductor companies with a little sprinkle of quantum on top from some of the smaller stocks. But let's now move on to my last stock, which is also in the quantum space, and then after that, I will share every stock that is currently in my stock portfolio. So this next company just deployed its first quantum computer outside the US, and they have been a leader in practical quantum, including partnering with insurance company Moderna to actually apply it to medicine problems today. So IBM is the leader in quantum machines from my point of view, with computers in the field and paying customers today. Now, IBM admits that it is still early days for quantum, but the reason I like this stock is the companies that get the lead today will likely maintain the lead going forward, just like we saw with the big tech companies that invested in AI early on. So I bought 15 shares in IBM worth $3,700. The stock is down around 4% while I've held it, but this is a super long-term hold for me. So let's look at my full list of stock positions. And by the way, we're starting to gain ground on the Motley Fool in number of subscribers. So if you've enjoyed the video and you haven't already, consider subscribing. But this is my full stock portfolio, which I will also share over on my Instagram at RealFinTech, along with daily stock updates and any research that pops up over the course of the week. And next up on your YouTube watching buffet, YouTube says that this video right here, this is the best video for you to watch next.